Say hello once you're in here. What's going on, everybody? See money. I like that one. Actually, my friends used to call me, well, not it wasn't a sticky nickname, but I have been called C Money in the past, many years ago. What's going on, Jake? Happy Friday, everybody. Gonna try to go through a not a big presentation, but we're gonna talk about early assignment today. So I'm just gonna wait for people to file in, get some viewers going, and then we will start. But today we're gonna talk about early assignment. I know I've done a video in the past, which was helpful to a lot of people, but also annoying to many others due to my repetitive nature. So today we're going to talk about early assignment, what it is, why people worry about it, and why you should not worry about it in most cases. We'll talk about when to exercise options and when to not exercise options, which will make up the bulk of it. What's going on, Evan? Sorry I haven't replied to your email yet, but I'm getting around to it. Don't get my expiration dates messed up this time. That's a good piece of advice. Last time I sent everyone into a tizzy. BJ says, thank you for the work you've done. I've learned 90% of all that I know about options through your content. Glad to hear it. And thank you for being a viewer. I appreciate it. Tesla, what's Tesla doing? In the dumps. Yeah, Tesla's been having a rough ride recently. But that's the overall tech market as well. The interesting thing is, I don't know if you've ever done this, but everything is very correlated. So if you look at QQQ, which is the NASDAQ 100 ETF, and then you look at Tesla, just look at this chart really quickly, the end of this chart, the past couple months, and then I'm going to switch to Tesla. It looks very similar because technically Tesla's in the S&P 500, but it's technically a technology company, in my opinion. But the overall market is, well, the technology side of things is kind of struggling recently, so that's why we've seen a big dump in a lot of these tech stocks. But yeah, how's everybody's day going? Happy Friday. Let me know if you have any questions that you'd like to... Actually, let me know if you have any questions about early assignment, since that's what we're going to start to talk about in a little bit. Do you have any questions about early assignment or any concerns about early assignment? Hello, how's it going? For those of you just joining, we're going to be talking about early assignment to start. That's going to be the first portion of the live stream, and then we'll go to the general Q&A. Sean Holmes asked, if you buy a deep in the money call, can you sell covered calls against it without needing more collateral? Yes. So if we go to Apple, let's say he's talking about a deep in the money call. So let's go to May 2021. And a deep in the money call could be, let's look at this 90 delta option. So this 100 strike call in Apple, let's say you wanted to buy this. If you owned this call option, then you could sell a higher strike call against it, and it would actually reduce your margin requirement. So you would not have to put up any more collateral to sell or short a call option against a call that you already own, given that it is in the same expiration cycle and you are selling the same or less in new short calls than you already own. So for example, if I owned 10 of these call options at the 100 strike, I could short up to 10 calls at a higher strike, and it would reduce my overall margin requirement. So you wouldn't need to put up more money to short the calls against the calls that you already own, because a short call position is only risky if you don't have it covered by anything. And what I mean by covered is if you short one call option and you buy 100 shares of stock, then it is a covered call position, because the risk of the short call is covered by the shares that you own, the 100 shares specifically that you own. And so if you bought a deep in the money call option, you could short a call option against it and not put up any additional collateral. In fact, it would reduce your margin requirement. So I can kind of simulate this to you. If we just look at the buying power effect in the bottom hand corner here, if I wanted to buy 10 of these 100 strike call options in Apple, they're trading for $20.60 a piece, which is $2,060 a piece. And to buy 10 of these, my buying power effect would be reduced by $20,600. And so if I just go ahead and short a higher strike call against these calls, we will see that it reduces this buying power effect from 20,000, and let's say I short the 120s, then now we can see the buying power effect is $14,750. So that kind of simulates what would happen. So if I initially just owned these 100 calls and I didn't have a short call position, and my margin requirement was $20,000, and then I came into the market and shorted 10 of these 120s for $5.90 a piece, or collect $590 for each of the 10 contracts, then I would collect just under $6,000, and that would actually reduce my existing margin requirement by $6,000. So to answer your question, if you buy a deep in the money call, can you sell covered calls against it without needing more collateral? Yes. In fact, it will reduce your margin requirement on that position. Brave Dave says, hey CB, love your stuff. Thank you. I learned so much. Sometime this stream, would you go over pros and cons of in the money versus out of the money leap calls and your preferences? Yes, I can do that. But I would like to start with the early assignment discussion that I have advertised on this video. And so I'm going to go ahead. First, I'm going to check how many people we got. All right, 100 people, whatever. Let's get into it. So let's talk about early assignment. So today we will explore the concept of early assignment, which in my opinion is the number one most common worry among options traders that I have talked to over the years. So with my YouTube channel, I have seen thousands and thousands of YouTube comments come in on my videos, and people have also emailed me lots and lots of questions over the years. And one topic that always keeps coming up is early assignment. If you don't know what early assignment is when a trader exercises their option that they own before expiration, and that means a person on the other side of that trade, meaning a trader who is short that same option, will essentially be forced to buy or sell shares of stock, therefore converting their option into a stock position. So as an example, if I'm short the 135 call in Apple and I get assigned on that 135 call, what that means is I will be forced to short 100 shares of Apple at $135 per share. And that's because if somebody owns the 135 call and they exercise the 135 call, they will purchase 100 shares of Apple at $135 per share. Now, there's always a balance to every single trade or transaction that happens in the market. And if a trader exercises the 135 call and purchases 100 shares of stock at $135 a share, then that means there is someone in the world who will have to sell or short those 100 shares of stock on Apple. And in this case, the strike price is 135. So if I was short the 135 call on Apple and I get assigned, that means that I will have to sell or short 100 shares of Apple at that strike price of $135 per share. Now, why is early assignment such a big worry for options traders? I think the simplest explanation is because if you are assigned on a short option, then your option position is forcefully converted into shares of stock, long or short, and traders don't like the idea of their position changing suddenly without them having control over that change in the position. So what I want to do today is go through some options and talk through why I would or would not want to exercise that option. So since we're looking at Apple, let's go ahead and use an example on Apple. So let's go to the May 21, 2021 options, and let's look at a call option. So first of all, let's go to this 115 call option here. And I'll tell you why I'm going to choose this in just a minute. But let's first record some of these metrics here. So Apple is at 119.50. That's the stock price. Let's go ahead and record that. 119.50. And we're going to look at the May 2021 115 call option. And this option is currently trading for $8.50. Let's just make it really easy with the math. So with the stock price at $119.50, and since I am looking at a call option with a strike price of 115, sorry, I'm just reading the chat. If we're looking at a 115 call option and the stock price is $119.50, then how much intrinsic value does this option have? Say it in the chat. This is a quiz. The intrinsic value of this call option with a strike price of 115 and the stock price at 119.50. Anybody? Any answers? The answer is $4.50. There you go. Nice job. And what this means is since the call option that we're talking about has a strike price of $115, that means if somebody owns this call option, they have the ability to purchase 100 shares of Apple stock at $115 per share. That's the strike price of the option. Since the stock price is $119.50, the intrinsic value of this option is $4.50, because if you own this option, you can buy 100 shares of stock $4.50 lower than the current stock price, because that's what the 115 call represents. So if I exercise this option, I will purchase 100 shares of stock, Apple stock, at $115 a share. Now with the stock price at $119.50, if I exercise this call option, I will purchase 100 shares at $115 per share, and with the stock price at $119.50, then technically I would have a gain or a benefit of that transaction of $4.50. Because if I wanted to, I could sell those 100 shares in the market for $119.50, and based on my purchase and sale price, I will make $450 on 100 shares because I'll have a $4.50 gain since I buy at $115, sell at $119.50, and if we multiply that $4.50 gain times 100 shares, we get a profit of $450. So buying 100 shares at $115 and selling them, you don't have to sell the shares, but I'm just gonna say selling the shares so we can deal with a realized profit. And sell at $119.50, I make $450 on 100 shares. But what did I give up? When you exercise an option, you are essentially trading the option that you have and you are converting it into the share position. And in this case, the share position would be buying 100 shares at the call strike price, which is $115 per share. Now, the option price right now is $8.50. So what does that mean? So if I exercise this call option, let's say I bought it right now. I bought it for $8.50, and since it was in the money, I decided that it was a good idea to exercise the option. If I buy this option for $8.50, I will purchase it for a total premium of $850, since we have to multiply that price by 100, since it can control 100 shares, and therefore I would pay $850 for this call option. If I immediately exercise this option, then I will be trading the call option in exchange for buying 100 shares at the call option strike price, which is $115 per share. And with the stock price at $119.50, I make $450, but I gave up an option that was worth $850. So the reason that this option or exercising this option doesn't make sense is because exactly what people are saying. The option extrinsic value is $4. And when you exercise an option, you only get intrinsic value because you, as I said, when you exercise an option, you are trading that option in exchange for the stock position that you can get through whatever that option benefits you by. So if you have the 115 call and you exercise it, you're saying that you want to buy 100 shares at 115 per share. But you give up your option in exchange for using that ability. And so since this option has $4 of extrinsic value, that's included in the value that you're giving up. So basically by exercising this option, I trade an $850 option in exchange for a $450 gain on the shares. And so basically, if we were to do all of these things right now at the same time, so I buy this call option right now for $850, and then I immediately exercise that option, then I will give up that $850 option. I will purchase 100 shares at 115, and with the stock price at $119.50, technically I'll have a $450 gain on that transaction. However, I traded that situation for an option that was worth $850, and therefore I actually lost $400 on this. So I lose the extrinsic value of $400. And so where this brings us is people will worry about early assignment immediately when an option becomes in the money. So let's say I'm short the 120 call option here. People will have a position such as, let's say they're short the 120, 130 call spread. And as soon as Apple gets above $120, traders will often start worrying about early assignment because the only time you'll be assigned on an option is if you are short an option that is in the money, meaning it has intrinsic value, as we discussed in this Apple example. However, as we've explored, when you exercise an option, anybody who does that will lose the extrinsic value that exists in that option. And so if your option is barely in the money, then it will mostly consist of extrinsic value. And that's the case if we look at this 115 call. So we can see that the 115 call, while it does have an intrinsic value, it has close to $4 of extrinsic value. And when you exercise an option, you trade that option's entire value for the share position that you get when you exercise that option. And so a trader would never make a decision on purpose that would result in an unnecessary loss. And so if an option has any substantial amount of extrinsic value, the likelihood of an option being exercised is extremely low. And if the probability of that option being exercised is extremely low, then the probability of being assigned is extremely low, because you can only get assigned if somebody exercises that option. So if we were to look at these call options on Apple, I have open extrinsic value in one of these columns, which is EXT. And this is a very quick way that you can gauge whether or not you are at risk of being assigned early on an option position, is to look at the extrinsic value that exists in the option that you are short. So if we've already covered the 115 call, what about the 105 call? Well, the 105 call, it has just about $15 of intrinsic value, but it still has $1.50 of extrinsic value. And that means if somebody were to exercise this 105 call, then they would effectively give up and forfeit $155 of value for no reason whatsoever. And so there would have to be some strong incentive for them to give up that value. Otherwise, they're not going to do it. And so if we go to a more extreme example, let's say you are in the April expiration cycle, and one second. Let's say you're in the April expiration cycle and you're short the 95 call right here. This 95 call has just about $24 of intrinsic value, and the remainder of that value is extrinsic. So this option here only has 20 cents of extrinsic value, and therefore the cost of exercising this option is much lower, and for that reason it has a much higher likelihood of being exercised by a trader who owns this call option. So really what I'm trying to get across here is your option needs to be super deep in the money, or it has to be in the money with very little time left until expiration for you to be in a situation where you would be at risk of early assignment. Because the only way an option is going to have very little extrinsic value, and by very little, let's just say less than 25 cents, the only way an option will have that little extrinsic value, if it is in the money, is if it has very little time to expiration and it is pretty deep in the money, or if it has more time until expiration, but it is even more in the money. So if we go to, let's really quickly compare two options in different expiration cycles that have 25 cents of extrinsic value. So by looking at this EXT column here, in the May 2021 expiration cycle with 56 days to go, let's see what option we have to look at that has 25 cents of extrinsic value. So right off the bat, I can see it is the 75 or the 70 call option. So with 56 days to go until an option expires, we need to look at a call option that is basically $50 in the money before we see any substantial assignment risk, early assignment risk. So you'd have to be short one of these options to be at risk or at high risk of early assignment. But let's go to the April cycle, which has 21 days to go, so a lot less time until expiration. And then let's find the option with about 25 cents of extrinsic value. And now we can see that basically that's the, let's just call it the 100 strike. So with only 21 days to go, your option only has to have about $20 of intrinsic value, meaning that you'd have to be short this 100 call as opposed to being short the 75 call to be at severe risk of early assignment. And so basically, to summarize it, if you are short and in the money option, unless it is super deep in the money or it has very little time until expiration and it is in the money, then in most cases you will not have any worries of being assigned early on that option. And that's because, once more, when you exercise an option, you give up the entire option's value, which includes extrinsic value, but your benefit is only going to be equal to the intrinsic value. So using our example from earlier, what I mean by that is this intrinsic value based on these prices is $4.50. So if I own the 115 call and the stock price is at 119.50, this option has $4.50 of intrinsic value. And if I exercise this option, this is what I will get. This will be my benefit, is the intrinsic value. That's why it's called intrinsic value, because it's technically the real value that an option has. So if I buy shares at 115 and they're currently at 119.50, that's a $4.50 benefit for me as compared to simply buying the shares at the current stock price of 119.50. But when you exercise an option, you give up the entire value, which is not just intrinsic value. You also give up extrinsic value. And for that reason, based on this particular example, a trader would never exercise this option unless there was a stronger incentive than $400 to exercise that option. So, based on all of that, does anybody have any questions based on everything that I just dumped on you? Because I know we moved pretty quickly there and I covered a lot of information. So if you have any questions about early assignment and what I just said there, then please go ahead and ask those now. Red approves. Thank you for the $5 super chat. What's the pitfall of selling call spreads on expiration date with high probability to expire worthless, especially with high IV? Too good to be true? Well, I wouldn't say it's too good to be true, but you're basically going to take a lot of risk for very little reward. So an example would be these options right here are expiring today. Apple stock is at 119.35. So if I wanted to sell the 121 call spread, this call spread is essentially at the money. So if I were to short this 121 call spread expiring in a few hours, an hour and a half from now, then I will only be able to make 10 cents on this trade, but I could lose 90 cents. So my max profit is $10. My max loss is $90. And the only thing that needs to happen is Apple needs to go from 119.50 to 121, which is a $1.50 increase over the next hour and a half. And essentially I will lose 9 times more than my maximum potential profit in this trade. So the reason that you wouldn't do it is your risk to reward is going to be really poor, and you're going to have to get really close to the stock price. So notice, as I mentioned, Apple's at 119.50, and if I wanted to sell a spread at these prices, then I would essentially have to sell the 120. That'd be the closest out of the money option I could sell. And if I wanted to create a spread, I could buy the 121 or the 122. But see right here, like, it still doesn't make sense because my max profit here is $10. My max loss is $90. So there's really no reason that I would make this trade, given that Apple only has to increase $1.50 over the next hour and a half for this position to achieve its maximum value. And therefore I would lose 9 times more than my best case scenario. And for me, that's just not a good trade. You could also go to, like, if we look at the 121, 122, you can sell this spread for 2 cents, but it doesn't really, your commissions are going to be more than that. So if I sell this spread for 1 penny, I can make $1, but I can lose $100 And that's just not a sustainable way to trade options, in my opinion. Now, if this were earlier in the day, because these options are expiring in an hour and a half, and so they're going to be trading with very little extrinsic value. And as I said, you're going to have to sell options very close to the stock price to get any sort of premium. But if it were earlier in the day, say this was 9 a.m., then you would be able to sell an at-the-money spread for a lot more. But still, in my opinion, it's just not worth it because you're going to have a lot more risk than your potential reward. And since it is expiring today, you're basically going to have a very binary situation where you're either going to make money really quickly or you're going to lose a lot of money very quickly because the stock price only has to make very small movements for the spread to change in value by a huge amount. And so for me, it's just not worth it. I don't like to put on trades. I don't like to put on trades where I have way more loss potential than profit potential, especially if it is a 0-day trade where I'm going to be trading in and exiting that same day. It can just go wrong very quickly, especially like what if I were to sell a straddle or something right here. Let's say I sell the 119 straddle. I can only make $70, and that's if Apple stays right around 119. But what if in 30 minutes some unexpected Apple news comes out and Apple goes to $123 per share? Well, then this 119 straddle, if Apple goes to 123, then this straddle will be worth $400, and I'll essentially lose $330 on this in just a few minutes. And so based on the max profit of $70 and the potential to lose more than that if there's some unexpected movement, it's just not worth it for me. So yeah, Saturday night, is that how you say it? Catterday night? He's saying it's like gambling, and that's what I would say. So in general, my belief is that the shorter term you go with your trades, the more it is like gambling, because the more you need things to work out in your favor and in a very short amount of time when you go with shorter term trades as opposed to longer term trades. So for example, if I went to just a 21-day spread and I sell, let's say I sell the 125, 130 call spread, the risk reward still is pretty poor. But at least in this case, if Apple goes from 119 to 123 over the next couple hours, or the next hour, I should say, then this spread, it will gain value, but it's longer term, which means its value will move more slowly as compared to a shorter term spread. Because shorter term options are extremely sensitive to changes in the stock price, which is shown by the Greek gamma. Gamma tells you essentially how fast an option's delta will change based on changes in the stock price, and delta tells us how sensitive that position is to changes in the stock price. And so a high gamma position will have very sensitive directional exposure when that stock price changes, and that's typically not what you want. Unless you own options, then gamma works for you. Omar asks, so are short verticals safe from early assignment? No. Whenever you have a short option component in your spread or in your option position, you can be assigned on that short option. So anytime you have a short option, you can be assigned. The purpose of what I was talking about earlier is to show you that to be assigned on a short option, typically it needs to be really deep in the money. So getting back to this May expiration in Apple with 56 days to go, I have extrinsic value plotted on this column right here. So this just quickly tells me how much of this option's value is extrinsic. Now, generally speaking, the more extrinsic value an option has, the less likely it is to be exercised, because if you exercise an option that has lots of extrinsic value, you're essentially giving up that value for no reason. So we talked about earlier, if I were to buy this 115 call right now for $850, it has $4.20 of extrinsic, which means if I exercised it, I would effectively just give up half of this option value for no reason. But with a short vertical, let's say you're short the 110, 120 call spread. With your short call spread here, you are short the 110 call, which means you have assignment risk, or you could be assigned on this 110 call if someone exercises the 110 call. But it's extremely unlikely for someone to exercise the 110 call unless it has extrinsic value close to zero, let's just say less than 25 cents. But we can see that this 110 call has extrinsic value of $2.50. So you would not be exercised on this option. It's extremely unlikely for you to be exercised on this option if you were short this call spread. Now, another thing to point out, what if you did get exercised on the short call portion of a call spread? Well, let me actually just illustrate this for you, because I actually like drawing in PowerPoint. So I'm going to draw this out for you. So let's say we have, one second. So we have our stock chart here. Now let's say this is the stock price, and here is your short call. So the dashed line is your short call. The solid line is your long call. So let's say short call, and then let's do the long call is up here. Now, if you get assigned on this short call, you will sell or short 100 shares of stock at this strike price. If assigned on the short call, you will short 100 shares of stock at the call's strike. So let's say you get assigned on this short call. Now you have a short stock position right here, and that short stock position is more specifically going to be shorting 100 shares of stock. So if you get assigned on this short call, then you will have unless you own shares already, you will have a share position of negative 100 shares right here. But your long call still serves as protection against that short call position. Because remember, with your long call, you could buy 100 shares at the strike if you wanted to. And so if you're short 100 shares of stock here, and you have a call option that allows you to buy 100 shares here, it doesn't matter if this stock price is where it is, or if the stock price, or if the stock price goes to 1,000,000, because it doesn't matter if the stock price is here or if the stock price is here, you still have this long call right here, which allows you to buy your short stock position at this fixed strike price. So the long call, even though you got assigned on the short call and now you have 100 shares of short stock at this price level, since you still own the long call, the risk of your position doesn't change. Okay? So if we go back to this Apple position, let's say I'm short the 110, 120 call spread. Now let's just say, for simplicity's sake, let's say I sold it previously for $3.50. Let's just say in a hypothetical world, let's say in a hypothetical world, you sold this 110, 120 call spread short, and you initially shorted it for $3.50. Based on that, your maximum profit is $350, but your maximum loss is $650. And that's because the maximum value of this $10 wide call spread is the width of the strikes, which is $10. So if we sell something for $3.50, in option terms, that means we collect $350 in premium, and the most that this spread can be worth at expiration is $1,000. So a $10 spread value times 100 gets us a maximum value of $1,000. And so if I short something for $350 and its maximum value potential is $1,000, my maximum loss potential is the difference between those prices, which is $650. Now let's say I'm in this short call spread, and I get assigned on the 110 call. What this means is that I will short 100 shares of Apple at $110 per share, but I will still own the 120 call option. So what that means is, let's say Apple goes from 120 all the way to $200 per share. Okay? And I'm short 100 shares at $110 per share. Let's go ahead and do some math here. So I need to delete all this. Just give me one moment here. No. So, one moment. Just got to delete all this garbage. Whoa. All right. So, shorted 100 shares at $110 a share. I still own the 120 call option. If Apple goes to $200, then my short share position will lose $9,000. Okay? Because if I short 100 shares at $110 per share, and the stock price goes to $200 per share, I will have a $90 loss on 100 shares equals $9,000 loss. Because I shorted 100 shares at $110 a share, and the stock price went to, well, you guys got it. This is too much text. But as I mentioned, I still own the 120 call. So value of the 120 call, how much would the 120 call be worth if Apple was at $200? What is the intrinsic value of the 120 call if Apple goes to $200? $80 of intrinsic value equals $8,000 option value. And so what we get from this is a total P&L. If we combine these two, I have a $9,000 loss on the short shares minus an $8,000 value that I can sell the 120 call for. So I can sell the 120 call for its $80 of intrinsic value. Let's just say it doesn't have any extrinsic since it's so deep in the money. Since I still own the 120 call, I can sell the 120 call for $80, therefore taking in $8,000 in cash in my account. And so what we get is a loss of $1,000 minus $8,000 value in the call, long call, is a total loss of $1,000. Okay? And so if I lost $9,000 on the short stock position and I close that out, so I buy back the short shares and I realize that $9,000 loss, but at the same time, I sell the 120 call and collect $8,000 into my account, then what I'm left with is a $1,000 loss. However, we can't forget about my entry credit here. My entry credit, I said, was in a theoretical world. Let's say I sold this 110, 120 call spread for $350. My entry credit was $350. So if we take that $1,000 loss and subtract the credit that I initially received, then $1,000 minus $350 entry credit equals $650. And so if we compare this $650 loss because I shorted this call spread for $350. The stock price went up. I got assigned on the 110 call, and then Apple went to $200. So now I have a $9,000 loss on my short share position, and I still have the 120 call because I didn't exercise it or anything, and you can't get assigned on an option that you own. And with Apple at 200, the value of the 120 call is therefore $8,000. So when I take my loss on the short stock position and then I sell that 120 call, my total loss is $1,000. But since I initially entered that overall position and collected $350 for it, my total loss is $650. If we look at the maximum loss potential of this spread, the 110, 120 call spread, if I short it for $3.50, it says my maximum loss is $650. So it doesn't matter if the stock price goes up and you don't get assigned at all and you take the full loss on that spread, your maximum loss potential will still be the same if you get assigned on the short call and the stock price goes to the moon. Your risk isn't higher after you've been assigned. Your risk is the exact same after you get assigned. It's just that the structure of your position changes. Somebody asked, what if absolutely nobody buys your 120 call? On a stock like Apple, that is not a legitimate concern because basically if you own a call option on a very actively traded stock like Apple, you should have no problem exiting that position. So if you're trying to get out of let's just go to options that are expiring today. Let's say you own this 100 call option and you want to sell it because expiration is in an hour and you're basically holding this option. We can tell by looking at this price and by looking at the EXT column, this option has basically no extrinsic value. So all of this option's value is intrinsic. So I would want to go and close this option that I own. And a person is asking, what if you want to sell that option and nobody wants to buy it? And this brings up a really good point. So up until this point in the video, we've talked about why exercising an option is usually not a good idea, because if you have a lot of extrinsic value in that option, you're going to give up that extrinsic value and lose it if you do exercise an option. And you would never want to give up value unnecessarily, and that's why it is extremely unlikely for somebody to exercise an option that has a lot of extrinsic value. So my first thing would be that I think you would have a very easy time closing an option position that you own in a stock like Apple, since it is very heavily traded. But let's say you tried to sell this option that you own and nobody wanted to buy it. Well, then you would have to reduce your price. And I would say that there would be some scenarios where maybe you have to sell the option for less than the intrinsic value. So for example, with Apple at 1905 or 119.05, this 100 call option has $19.05 of intrinsic value. So if I were not able to be filled at this value of 1905, then what I would do personally is I would just reduce the price by a couple pennies. And you would definitely be able to get filled a couple pennies less than intrinsic value, which technically means that you would be giving someone else risk-free profits on the other side. But it would only be a couple pennies on an option that's worth $2,000. So it wouldn't be a huge deal for me, but at the very least, if you wanted to capture the intrinsic value, then you could exercise the option. Because as an option owner, you have full control of when and if you exercise that option. And one scenario where it would be advantageous to exercise an option is if you owned it and you could not sell it for intrinsic value. So let's say I couldn't get filled at $19. Apple is at $119, so that means this 100 call basically has $19 of intrinsic. Let's say you tried to sell this option for $18.70. You'd basically be selling for $30 less than intrinsic. If you could not get filled at this price and you didn't want to give up any more value and basically lock in a negative trade against you, meaning that you're essentially giving up free value if you don't sell your option for at least intrinsic. And if you couldn't get filled on this, then what you could do is you could exercise the option, and therefore you would forcefully take the intrinsic value of that option, because if you buy 100 shares at $100 per share, which is the strike price of this call option, and then you immediately go and sell those shares at $119.15, then you will capture $19.15 of value, since you would buy 100 shares at $100 and you could sell them right away at the current market price of $119.20. And by doing so, you would capture all of the intrinsic value in that option, because that's what intrinsic value represents. What gain could you make by purchasing at the strike price as opposed to the current stock price? So to make a long story short, if you owned a call option that was in the money and you couldn't sell it for at least intrinsic value, then an option available to you is to exercise that option. And by doing so, you would forcefully take intrinsic value that exists in that option. So I know, again, I just dumped a lot of information on you, but basically, I don't think you would have a difficult time selling an option for intrinsic value on something like Apple. And worst case scenario, I would say, is that you'd have to sell maybe 5 cents or 10 cents less than intrinsic value. And I would say there is a very good chance that you would get filled on that, because whoever takes the other side of that is likely a market maker of some sort, and they will facilitate your transaction in exchange for giving them a small risk-free profit. So if you sell an option for less than intrinsic value, technically you are giving the other party a risk-free profit. So we got another question. Jude asks, what if you have a small account, enough collateral to open a spread, but not enough money to cover if the short leg is exercised? Price lands between the short and long leg. So I think you're asking, first of all, if we're talking about this May spread here, so let's go back to the 110, 120. First of all, you would not get assigned on this 110 call with $2.50 of extrinsic value existing in that option. It's highly unlikely. However, if you were assigned on the short option portion of a spread, and for some reason you had margin issues, then what you would have to do is you would have to buy back the short shares and sell the call that you own, which is a 120 call. And you'd have to sell, well, at the very least, you'd have to get rid of the short stock position, because that is what is causing the margin issue, because a short stock position is a highly risky position, and owning a call option is much less risky because you don't have unlimited loss potential. Technically, the long call that you own covers the risk of your short stock position. So I think it depends on the brokerage platform. I wonder if Apple will actually cover the margin. Well, let's see if we can construct a position that's short stock and a long call, and let's see what it's margined at. So if I short 100 shares and buy the 220 call. Okay, so tastyworks is saying that I still have to put up $11,000 in margin requirement, but the maximum loss of this position is technically $750. That's because if I short 100 shares here at $217.50 and I own the 220 call, then technically my risk is capped at any price above 220. So if the stock price goes to $1 million, I can still buy 100 shares or cover my short shares at 220, which means I wouldn't have that massive loss associated with simply having a short stock position. As we can see here, has an undefined max loss limit. So there's no limit to how much you can lose if you short 100 shares of stock and it is not covered by something. So if you do get assigned on a short call or a short option as part of a spread, and you do encounter margin issues, then unfortunately you're going to have to unwind that position And I would recommend starting with the riskiest part of it first, and that would be a short stock position. So if we go back to our Apple example, if I have the 110, 120 short call spread and I'm assigned on the 110 short call, then I will short 100 shares of Apple stock at 110 per share, but I'll still have the long 120. And the risky part of that position would be the short stock. Even though technically the risk is covered by the long 120 call, but what's causing you margin difficulties is going to be that short stock position and not the 120 call. And so basically you just have to cover the short shares that you got assigned. And that would be really easy because you could just, if you got assigned 100 short shares on Apple, all you'd have to do is go up here, you'd click buy 100 shares, and you could cover the shares that you're short. And you just send that off. And since Apple is such a liquid stock, you would effectively get filled on that right away, and you would close out your short stock position in just a couple seconds. But then you'd be left with the long 120 call, and then it becomes your choice what you do with that. So you could continue to hold it, but if you continue to hold it and Apple is below 120 at expiration, then you're going to lose another $580. Whereas if you initially entered it as a short call spread and you did get assigned on the short call and for some reason you had to unwind that short stock position due to margin difficulties, then I would probably close the 120 call and just get out of that entire position and then start all over again. Yeah, Time Rider says if you have an option and there are people bidding and you meet the bid price, it will be filled. So what they're saying is if I own this 120 call option, the bid price is $575, the ask price is $585. So if I sell this for $575, I'll get filled instantly. Sorry, what I was just queuing up was buying it. If I were to sell this, I could get filled instantly by hitting the bid at $575. So the bid price here is the highest price someone is bidding for this option, meaning the highest price they're trying to buy the option for. And if you sell something right at the bid price, you will get filled instantaneously. So I can just go ahead and show you guys really quick. I mean, do I really want to do this? So let's trade in and out of this and just do this very quickly. So when you queue up a spread, what this price in the bottom is, this is the mid price. This is $3.45 as the mid price, and that's being calculated by taking the midpoint of the short call, which is the short 120 call, and it's taking the midpoint of the long 130 call. If I look to the left here, we see that there's this nat price. This is the natural price, and that's $3.37. So basically, if you try to sell a spread at the natural price, you'll get filled instantly. And that's a worse price for you than the mid price. So notice that the mid price is $3.50. If I sell this spread here, I will collect $350. But if I go to the natural price of $3.37, then I will only collect $337. But on a stock like Apple, typically you'll be able to get filled right at the mid price. So let me just go ahead and try to execute this spread at the mid price, and let's just see what happens. My suspicion is that I will be able to get filled here instantly, or I could get filled pretty much instantly at $3.45. So let's go ahead and just send this. So it didn't go through. The mid price is, well, if we go to Apple here, I'm underwater on some of these Apple positions. The mid price is $3.49. My limit price is $3.50. If I go ahead and cancel and replace this and go to $3.45, I'll probably get filled on this. There we go. So I had to reduce my price a little bit to get filled on this. And if I wanted to unwind this position, I could do it in a spread, or I could do it one by one. I don't really know why I'm doing this. I'm just kind of showing you guys trade execution. But basically what we were trying to discuss is that you can get filled instantly by going to the bid or the ask. So if you're buying something back, in the case of buying back this short 120 call, if I go to 590, which is the ask price, I will be filled instantly. There we go. And so I got out of that. Now I still have the long 130, so I need to get out of this. This is 2 pennies wide, so I'll probably get filled on this instantly at 238. It's taking a second here. But if I go down to the actual bid price of 237, this will fill it instantly. So now I just moved it though. So I went down to 237 and now it actually moved the bid price 1 penny lower. So there we go. So it's that easy when you're trading a very liquid stock like Apple. But yeah, to make a long story short, a lot of people have that question where they are fearful of not being able to fill their trades. And what I say to that is, first of all, if you stick to really liquid products like Apple, or if you're trading something like SPY or IWM, these option markets are so active that you really should not have any problem getting out of the position. And the worst case is that you just have to go to the bid or the ask. So, and like I said, if you own an option and you're unable to sell it at the bid price, or I should specify, not the bid price, if you are unable to sell an option for its intrinsic value and you try to go a couple pennies less than intrinsic value and you still can't get filled, which would probably be the case if you were trading a very illiquid stock, then I would say exercising that option is a good play, because by exercising an option, you always capture the intrinsic value. And so if you're unable to sell the option for intrinsic value, you could forcefully capture intrinsic value by exercising that option. Yo, Al Lusag, what's going on, dude? How's it going, my friend? Those of you who don't know, I went to high school with Al. All right, where are we at here? Throw me your questions, whatever you want to know. We've gone pretty heavy into early assignment already and selling options for less than intrinsic. If you can't get filled, exercise the option. Thank you, Al. I got to come out and visit you. I've been to Nashville once, but I was with my dad, so we didn't really let loose. Icy says, "Hey Chris, guess who made money on GME again?" Where is GME? Jeez. GME is an absolute gambling vehicle, in my opinion. But this is exactly why traders love GME, is because it's extremely volatile. Volatility is good for traders. That's also why that's why traders love the cryptocurrencies too, because the cryptocurrencies are incredibly volatile. Got put 11.5 on GoPro. What do you think about that buy? GoPro. You bought shares at 11.50? Oh, sorry. Brave Dave is... Every time I try gambling on GME, I lose money. I'm done. I'm not trading it anymore. Hey, that's a good strategy. I think if you are unsuccessfully executing trades in something like GME, then just throw in the towel. It's okay. It's extremely volatile, so you have to be very ready for big movements. And that's why I think if you're actively trading short term, you have to have some sort of a system so that it's less stressful on your body. Because otherwise, if you're just winging it, then it could be tough. Brave Dave had some leaps questions. Let me go back. Brave Dave asks, out of the money, in the money leaps. And when do you consider closing your risk-free positions when underlying is falling? So in the money versus out of the money leaps, personally, if I'm going to buy, first of all, if I'm buying a long-term option, then typically that's a pretty directional position. So let's go to NVIDIA, for example. So NVIDIA is trading at $500 a share. I do own some leaps on NVIDIA, which are in the January 2023 expiration, almost 2 years out. If we look at the prices of these, so if you go out of the money, so NVIDIA is at $500 right now. If you want to buy the 600 strike call option, let's see, where is the high price? So NVIDIA's high price over the past few months has been $615. So if you buy the 600 call in NVIDIA with just under 2 years to go, then you're going to pay $7,200 for this option. And if we compare that to an in-the-money option, so let's go to the 400 strike. If you go to the 400 strike, you're going to pay $16,000. So the question becomes, do you want more leverage or do you want less extrinsic value? And what I mean by that is if you buy the 400 strike call option in NVIDIA, you're buying $100 of intrinsic value because the stock price is at 500. If you buy the 400 strike call, then you're buying an option that already has $100 of intrinsic value. And so that dramatically increases your entry cost. So if we look at the total cost of this option is just less than $16,000, but the extrinsic value is $5,200. And so if I buy this 400 call option for 16 grand and NVIDIA stays right at this current stock price through the expiration, then at expiration, my 400 call option will still be worth $100 or $10,000 in premium. And so if I buy this 400 call for 16 grand and at expiration, NVIDIA is at 505, then this call option is going to be worth $105. And therefore, I'm only going to lose 30% of the value as opposed to losing 100% of the value if you buy an out of the money option. So if I buy the 700 call or the 600 call, I am going to lose 100% of that value. So if I buy the 600 call and NVIDIA is at $500 in 2 years, then I'm going to lose 100% of this call's value because if NVIDIA is at $500 per share when this expiration arrives, then this 600 call is going to be worth $0, and therefore I'm going to lose $7,200. Now let's compare the delta values, because this is what really it comes down to, is how much leverage you can get. If I buy $15,000 worth of options, I can buy 2 of the 600s, or I can buy 1 of the 400. Okay, so if I can buy 2 of the 600 call options and I spend just under $15,000, my delta is 94. So that means if NVIDIA goes up $1, I'm expected to make $95. If NVIDIA falls by $1, I'm expected to lose $95. And also the total potential delta of this position is 200, because if I own 2 call options, each of those options could get to a delta of positive 100. And if I own 2 of them, that means in the future, if NVIDIA is higher than $600, the best case scenario is that my delta will get to 200, which would be a good thing if NVIDIA continues to go up. Because if NVIDIA goes up and my delta is 200, then I will make $200 for each dollar that NVIDIA's stock price increases. But if we compare that to buying 1 of the 400s, if I buy 1 of the 400s for $15,000, my delta is 75. So right out of the gates, I have less profit potential if I buy this 75 delta call option and NVIDIA goes up by $1. I'm expected to make $75 as opposed to the $95 that we already discussed in regards to buying 2 of the 600s. And then also the maximum delta value of buying one call option is 100. So if NVIDIA continues to go up and this delta goes up, the max delta of this one call option position is going to be 100, which means in the future, if NVIDIA is at 700 and my delta of this call option is 100, then I will make $100 for each subsequent increase in NVIDIA's stock price. So that's why traders like to buy out of the money options, is because you can get a higher quantity of contracts. And with the higher quantity of option contracts, you have more potential delta values in the future. So if I own 2 of the 600s, in the future, I could be making $200 for every $1 increase in NVIDIA. But if I only own one call option, then I can only make a maximum of $100 for each $1 increase in NVIDIA. So to make a long story short, when you're considering out of the money versus in the money leaps, it really comes down to how much leverage do you want? So do you want to favor buying more option contracts for the same amount of money? Or do you want to spend the same amount of money and buy fewer contracts and potentially give yourself a lower loss if the stock price does not move in your favor? Does that help? Does that help, Brave Dave? Jeez, we got a lot of stuff coming in here. Manlin, thank you for the $5 super chat. What is the meaning of cut the delta by 50%? The meaning of cut the delta by 50%, well, what that would mean is that you reduce your delta position by 50%. So to give you an example, if we look at, if you own the 500, well, actually, let's make this math much simpler. If you own the 580 call option in NVIDIA in this expiration, your delta is 50. And if you owned this option and you wanted to cut your delta position in half, then you would short an option with a delta of 25, which would be shorting the 820 call option. So by doing that, you would reduce your delta from 50, which is what you'd have if you only own the 580, and you would reduce it to 25, because since you own a 50 delta call, if you short a 25 delta call, 50 minus 25 gives us an overall delta of 25. So that would be cutting your deltas in half. And I've talked about that in past live streams with some of the positions that I have. One of the benefits of shorting calls against calls that you already own is that you reduce the delta exposure of that overall position, which is helpful if you've seen a massive increase in the stock price and you want to protect against decreases in the stock price. So if the stock price goes up and then you reduce your deltas, then if the stock price goes back down, you're going to lose less money compared to if you didn't put on that adjustment. So Brave Dave is asking, what about closing your risk-free spreads? So if we go to Tesla, I have this is one of the risk-free spreads I have, so the 700, 800. If we look, first of all, if we look at the trade prices, we can verify that this is a risk-free spread, because if we look at the 700, I bought this for $118, and then later I shorted the 800 call option, which is a higher strike call, and I shorted it for the same exact price, so $11,800. If I select both of these and I click close position, this will just quickly show me what this spread is actually trading for. And so we can see that the spread is trading for $25. So if I sold this right now, tastyworks is actually telling me that my profit would be exactly what I sell this for. So if I sell this for $25, I will make $2,500. And that's because I entered this position for a net zero entry cost. And if I sell it for $25, I will collect $2,500 into my account. And if I sell it for $2,500 and my entry cost is zero, then my profit is $2,500. So the reason I'm continuing to hold this is first, I don't have any risk in this position since I entered it for a net zero debit, which means my entry cost on the 700 call and my entry cost on the 800 call nets out to $0. So I don't have any risk on this position. And since the strike width is $100 wide, and also since this has 450 days to expiration, I have a lot more money that I could make on this spread. So if Tesla goes to over $800 per share by the time of this expiration, then this call spread could be worth $100. And if we multiply that by 100, the maximum value of this position is $10,000. So right now it's at $2,500, so it's only worth 25% of its maximum value. In terms of when I would look to close this, I would base it off of when the spread gets over $50, then technically my risk to reward starts to diminish significantly. So for example, let's say that this spread gets to $75. If it gets to $75, I could sell it and realize a profit of $7,500. And I just mentioned that the maximum potential value of this spread is $10,000 because it's $100 wide. And if Tesla is above $800 at expiration, then this spread will be trading based on the width of the strikes. Its value will be the width of the strikes. So if the value of the spread gets to $75 and the max potential value is $100, that means that I can only make another $25, but I could lose all $75 that I currently hold if I were to hold it and Tesla stock were to fall. So if the spread were to get to $75, then I have $75 to lose, and I only have another $25 to make, and therefore risk to reward would suggest that I should close that position since I've made a majority of what I can make on the spread, but I can lose everything that I've made up to that point. And that decision would be even easier if, let's say, the spread got to $90. So if I own this spread and its value gets to $90, then I can only make another $10 on it, or another $1,000 in terms of the overall value. But if I continue to hold it and Tesla stock craters, then I could lose $9,000. So in terms of closing spreads, a general rule of thumb is to consider how much more you can make and compare that to what you could lose. So right now, I can lose $2,500 if both of these things go out worthless, and I basically lose the unrealized profit. But if things go well over the next couple of years, then I could make another $7,500. So I can lose $2,500 in unrealized profit, or I can make another $7,500. So that's a good risk to reward for me, especially considering that I don't technically have any risk in this position other than the unrealized profit. And that's because I entered this spread for a net zero cost, which means I don't really have any risk based on where the account was when I entered the trade. And so that's how I think about closing this position. Is I'm going to look at how much more I can make versus the maximum potential loss that I could have if things go wrong. And if I can make a lot more than I could potentially lose, and if I also have very little skin in the game in terms of actual risk, then I'm going to continue holding it. So in this case, I'm going to continue holding the spread because I can make another $7,500, and I can only lose $2,500 of unrealized profits. But at the end of the day, as I said, my entry cost on this entire spread is $0, and so I don't really have any risk because it is a risk-free position since I didn't really pay money to enter this spread based on the entry cost of each component. If we look at the 900, 1500 call spread, we can see that this is also a risk-free position since I purchased the 900 call for $100. I shorted the 1500 call initially for $230, and then I bought it back for $117, and then I reshorted it for $117. So my overall credit on this call spread is like $24,000. So worst case scenario, if Tesla is below $900 per share at expiration, then I will technically still make $24,000 on this trade. But if we do the same analysis as before, this option spread has 660 days to go. And if Tesla somehow gets above $1,500 per share by expiration, then this spread could be worth 1,500 minus 900. That gives us a spread width of $600. If we multiply that by 100, the maximum value of this spread at expiration is $60,000. So currently, I can sell this spread for $70, but its maximum potential value over the next 2 years or so is $60,000. So if I continue holding this and Tesla continues to increase, the most that I can see this spread appreciate by is another $53,000. And again, it's very similar to the other position where I don't really have any risk in this trade. And so for me, the only real risk is losing the unrealized profits, which at this point are not too significant compared to what I could make if Tesla does increase over the next 2 years and this spread appreciates in value immensely. But again, Tesla doesn't necessarily have to go to $1,500. Let's say Tesla goes to $1,200 over the next 2 years, which isn't an insane thing that could happen. If it goes to $1,200 at expiration, this spread would be worth $300 because the $1,500 call will go out worthless, but the $900 call would be worth $300. And that would mean that this position has an overall value of $30,000. So compared to the current value of $7,000, if Tesla goes to $1,200 over the next 2 years, then this spread's value will slowly appreciate by another $23 to $30,000. So if it goes from $7,000 in value to $30,000 in value, then I'll make another 23 grand on this, and that's if Tesla goes to $1,200. But again, I entered this trade for a big credit, and so even if it goes out completely worthless, I will still make over $20,000 on that particular trade. Brave Dave, thank you for the $10 super chat. I appreciate it. So he says he has a free 400 SEP 21. So he's got the 400 510 call spread. And he's saying, so yes, this spread is actually pretty far in the money, and that's why it is trading for almost, not almost, but it's trading for more than 50% of its total potential value. So if Tesla remains above $510 a share over the next 6 months or 180 days, then this spread will appreciate from $7,300 to $11,000. So as I was mentioning before, since this spread is at $7,300 and its maximum potential value is $11,000, then this spread is getting to that point where it's closer to the max potential value than it is to being worthless. And for this reason, as this spread gets closer and closer to $11, like if this spread gets to $90, I would probably look at closing that spread. Because if it's at $90 and it can only be worth $110, you can lose all $90 if the stock tanks, but you can only make another $20. And so the risk to reward naturally suggests that you should consider closing that position, because it doesn't make sense to hold a position that you can make very little on, but you have a lot to lose on. So that's how I think about it. Why is in the money call's extrinsic value the same as out of the money put? So that gets to put call parity. Let's try to find an example. Technically, they should be very close. Let's go to EXT. So I think there will be a bigger discrepancy if you're looking at, Well, at the money options are pretty close, but let's go to something that's pretty deep in the money and doesn't have too much time left. So let's look at this 375 call option. The reason that these extrinsic values are very, very close. So we're seeing, first of all, the prices are jumping around a little bit because the market is rallying. But we can see that the extrinsic value of the 375 call is right around $2, and the extrinsic value of the 375 put is right around the same value. So they're kind of hovering around 190, 195. So they're asking, why is the extrinsic value the same? And it's because you can synthetically create the same position in two different ways. So to explain this, we're going to compare two different strategies. So the first strategy is buying the 375 call. So if I buy this 375 call, then I have $1,900.50. Hold on, let's just lock in this price at $1,950. So, well, actually, I'm going to keep it floating. So if I buy the 375 call here, I have unlimited profit potential and around $2,000 in loss potential. We're just going to round these numbers to make the math a little bit easier. The extrinsic value is $1.95, which means if I buy this 375 call and SPY stays right where it is over the time before expiration or through expiration, then I will effectively lose that extrinsic value of just around $200. So the risk profile of this 375 call purchase is that I have unlimited profit potential to the upside, but my loss is capped at 375 and lower. So if the stock price goes to zero, I will only lose $1,950. I can create this same exact risk to reward profile, or basically the same exact position, by using long stock and a long put. So a long call can be synthesized, or you can basically create a synthetic long call position by purchasing 100 shares of stock and then buying a put option at the same strike price. So if I buy 100 shares of stock here and I also buy the 375 put, look at my max profit potential. My max profit potential is uncapped because I own shares of stock. There's no limit to how high the stock price can go, and therefore, in theory, my maximum profit potential is unlimited. My maximum profit potential is unlimited. Sorry, I don't know if I misspoke there. My maximum loss potential is the exact same as that call position that we just looked at. My max loss here is $1,950. And that's because, first of all, if I buy 100 shares at $392.66 and the stock price goes to $375, then I'm going to lose that difference. So that's going to be about $1,750 that I'll lose on the stock position. But I paid just under $200 for the put position. And if the stock price goes to $375 and stays there at expiration, I will lose the full premium that I pay for that put option. So my $1,750 loss on the shares plus a $200 loss on the option gives me a net loss of $1,950. So buying a call option is the same exact thing as buying 100 shares of stock and buying a put option at the same strike price as the call option that you were initially looking at. And so that's why the extrinsic value of the 375 call and 375 put is supposed to be the same, is because technically you can create the same exact position in different ways, just using different components. So you can always synthesize an option position using the opposite option and shares of stock. And you can also synthesize a stock position by using options. And so that's my long-winded answer to why is the extrinsic value in out of the money or in the money option, why is the call and put extrinsic the same? And it's because you can create basically copies of each option using different components. Nobody asked any questions while I said any of that. It makes me worried. Jane Kaufman, thank you for the super chat. If I have 20 grand and I want to make $100,000 in 6 months time, can you suggest a strategy? Well, I'm not going to recommend any specific strategies, but what I will say is if you're trying to turn $20,000 into $100,000, then that means you're trying to 5x your account in 6 months. And the only way to 5x your account in 6 months is to be buying options. So I'm not going to make any specific recommendations just because I don't want you to hold me liable or anything. But what I will say is the only way to turn 20 grand into 100 grand in 6 months is to, yeah, you could trade futures because you get a lot of leverage. But I think trading options, primarily buying options, is going to be a much more doable thing than actually trading futures. And the reason I say that is because when you're buying options, your downside risk is limited to what you pay for that option, but your upside is uncapped because if you buy an option for $1 and then it goes to $5, then you basically 5x your money, but the most you could lose is that $1 that you initially purchased that option for. When you get into the world of futures trading, you don't have that risk to reward profile. Your risk to reward profile is 1-to-1 because if you buy a futures contract or if you short a futures contract, you're going to make the same amount of money if ES goes up $100 compared to what you'll lose if it goes the other way by 100 points. So if you bought this ES futures contract at 39.35 and it went up 100 points to 4,035, then you would make five grand, right? Because there's $50 a point in ES futures, and if it goes up 100 points, then you will make $5,000. Now, if you buy at 39.35 and it goes to 38.35, then you're going to lose $5,000. And so you don't have asymmetric return profiles, meaning that you don't have limited risk and huge upside when you trade futures, but you do have that when you trade or buy options. And so that's why, based on your target of making 100 grand with 20 grand in 6 months, it's a lot safer to use options to do that. And basically what you're going to have to do is you're going to have to make specific directional plays. So for example, you could think that Apple's going to go from 120 to 150 over the next 6 months. And then maybe based on that prediction, you go out to the, let's say, January 2022 options, and then you're going to have to buy something. So let's go ahead and look at, we can actually plot the changes of these option prices on a chart. So let's go ahead and look at what the 150 call in Apple has done over the past few weeks, knowing that Apple stock has gone from 145 to 120 over the past couple months. Let's go ahead and look at the 150 call. So if I right click on the 150 call and click view option and chart, then I can see the chart of this option. And I think this is factoring in a stock split, so just kind of ignore this. But over the last couple weeks, this option, which is the January 2022 150 call option in Apple, it's currently trading for $5, but a few weeks ago it was trading for $20. And so basically what this means is if you put your money into this option here at $5, and if Apple went back to 145, or let's just say it goes to 150 over the next couple of months, then it's safe to say that you will like 4x your money on this 150 call. But that's just an example. That is not a specific recommendation. I'm just telling you that based on your goal of taking 20 grand and turning it into 100 grand, you're going to have to make a directional play like that by purchasing options. And if you do that, I would go to a longer term expiration and not try to trade weekly options, because if you go to weekly options, you have a very high chance of just incinerating all of the money that you put into play. So by going to a longer term option cycle, such as the 300-day expiration cycle that we just talked about, it's unlikely that you will just incinerate all of your money, because since you have 300 days to go, the option is going to hold its value even if Apple goes against you by $10 or $20. So, but I should say that 20 grand to 100 grand is very, very aggressive and ambitious, and just be very careful with that. And you should only go into that if you're completely comfortable losing all 20 grand. If you're talking about 20 grand, that's your entire life savings, then I would be very careful with the strategy that you're proposing. But if you have $500,000 in net worth and you're going to take 20 grand and try to turn it into 100 grand, that's a different story. But I would say with the aggressiveness of what you're trying to do, you should be very comfortable with it working out disastrously, and that means losing all your money. So that's my honest answer to your question. Man, I wish we had Tastyworks in Canada. I think they're going to be available in Canada as soon as they get through all the regulatory stuff. Yeah, they said don't shoot for such a high target. Yeah, and another important thing to talk about there is, if your goal is to take 20 grand and turn it into 100 grand, then that means if you were to get to 100 grand, then that implies that you put 20 grand into a position and you actually held it through all of the profits that you would need to get to actually get to that $100,000 profit target. So that basically what I'm saying is, if you put 20 grand into an option position, to get to $100,000, you're going to have to watch that position get to $60,000, and you're going to have to also not sell. And so it's kind of a tricky psychological situation, because you would basically have to sit through and hold a $60,000 gain. Like if you put 20 grand in and then you turn it into 60 grand, the only way you get to 100 is if you don't sell and you still watch it get to 100 grand. But at the same time, if you turn 20 grand into 60 grand, then you kind of have to ask yourself, is it being greedy to continue holding and go for 100 grand, or should you just take the 40 grand profit that you have and therefore you triple up on your account? So just another thing to think about. But then in that scenario, if you take the profits and you're at 60 grand, then you're out of the position, and maybe the position does go to 200 grand and you exited way early and you actually didn't get that return. So there's a lot of psychology as well that plays into your strategy of trying to take 20 grand and turn it into 100 grand in 6 months. I was gonna talk about something, but it slipped my mind. Are you still bullish on Tesla? Yes, I am. I am bullish on Tesla. But if we look at the breakdown here, if I just look at this, $43,000 of the overall $73,000 is in stock. And so I don't really have to do anything with these shares of stock. There's no time limit here. So I can just hold this forever. And since the majority of the position is in a non-time sensitive position, I'm not too worried about it. But obviously, you've seen a big decrease in Tesla over the past few months, and we're going to have to make up that ground to make a lot more money on these positions that I have. Oh, what I was going to say is, there's a link in the description. Tastyworks is doing a offer right now, and if you open a brand new Tastyworks account as a new customer, it's only for new customers, Um, you can get up to $200 in crypto when you fund with $2,000 or more. If you fund with $200, then you'll get $50 worth of crypto. And this is just free. It's a free bonus they're giving you for signing up. And it says it's through June 30th, 2021. So if you do want to take advantage of that, then there is a link in the description below. And you can use that link to sign up, and you can take advantage of that crypto offer if you are so inclined. But again, as I always say, don't just sign up just to get that bonus. I would do research on the brokerage firms you want to use, and if you learn that tastyworks is a brokerage platform you want to use, then go for it. And they do have that offer standing right now through June 30th. So just wanted to point that out. You can get some free crypto. You can choose what crypto you get too. So if you use the link in the description of this video, you can choose which cryptocurrency you want to receive. So you could select Bitcoin, Bitcoin Cash, Ethereum, Litecoin. Personally, I would choose Bitcoin as part of that offer. When is Tasty Trade coming to Canada? I don't know. I don't work at Tasty Trade. I don't know the information on their day-to-day operations or when they're planning to launch in Canada. But generally speaking, I do know that as a US-based brokerage firm, opening up a brokerage firm or servicing Canadian residents as a US-based brokerage firm, you have to go through a lot of regulatory hoops. And I think that just takes a while. So tastyworks definitely understands that Canada wants them there bad, but unfortunately they have to go through the same regulatory hoops that everybody else goes through. So yeah, so Yilmaz asks, never be greedy. He says, never be greedy. I made that mistake. He bought 80 contracts, $7 Neo options, and they got up to $49. So he had 80 contracts of an option that was worth $5,000 a piece. So that's 400 grand. And now they're only 1740. So yeah, that was getting back to what I was saying earlier, is that at some point, if you do have a massive unrealized gain on your option position, then at some point you got to think about exiting that position, because unrealized profits are not real profits. And as I said earlier, if you take 20 grand and you're trying to make 100 grand, then that implies, even if you did get to 100 grand, that implies that you turned 20 grand into 40 grand, and then you saw it go to 60 grand, and you held through all of that, as opposed to taking your profits when you were up 100 or 200% on your account overall. And so it's a very, very difficult thing. And I know Nassim Taleb talks about that in one of his books, about kind of that fallacy. Like, the way he describes it as, he basically says, if you risk $5,000 to make $1 million and your probabilities are X, then you could break even over time. But he says that's kind of a fallacy, because if you take $5,000 that could turn into $1 million, and let's say the first 100 trades you lose, so you lose $500,000, and then you put on that $5,000 trade that does end up turning into $1 million, then that implies that you held it through that $5,000 turning into $100,000, and then eventually turning into $250, and then $500. And it's very unlikely that you would actually hold through all of those movements. So just saying that even if you lose $500,000 over 100 trades, but then on that one trade at the very end, you actually make $1 million, that's kind of a fallacy, because if you lost $500,000 on 100 trades, then on that next trade that does get to $1 million, maybe you would be incentivized to close it when it got to $500,000 just to break even. And there's actually no guarantee that you would actually hold until that position got to $1 million. So it's kind of a psychological fallacy to say it, but I understand what you're going for. Ben asked, do you have any long-term options, call options that you like right now, like the example you did with Apple? Actually, Apple is a good example. So yesterday, if we look at this option position that I have in Apple, 6 months ago, I purchased 5 of the 200 strike calls in Apple for $9.50 a piece. These are currently down 50% in value. So they went from $9.50, now they're trading at $4.50. So I'm down 50% on these calls. Yesterday, what I did is I bought 5 more. And basically what that does is it averages down my per strike cost to about $7.50 an option. So before I had 5 of the 200 strike calls at $9.50 a contract. And then yesterday I bought 5 more for $5.40 each. And so now I have 10 contracts total that I've spent 15, actually, hold on. So I bought five grand, 7,500. So I have 10 contracts total. The total outlay is 7,500. And so if we divide that by 10, we get to essentially $750 premium paid per contract, which reduces my effective cost for each of these calls, even though they are in different expiration cycles. Because yesterday I did go to the March 2023, which is 720 days away. And the reason I did that is because I think Apple's one of those stocks that anytime you see a sizable decrease in the share price, there's a really high likelihood that you're going to eventually meet a lot of demand from investors, because Apple is just one of those stocks that just has such good sentiment. And I also like Apple because they are going to benefit from the 5G revolution, so to speak. And so I think Apple, it's not one of those stocks where it has, 10 or 100x upside, but it is one of those stocks that I think will, at the very least, hold its value and trend higher. And so what I did recently was just added some more call leaps. But keep in mind that even though I own the 200 strike calls, it doesn't necessarily mean that I believe Apple is going to go to 200. What it means is that I just want leverage in Apple to the upside. And one of the ways I can do that is by purchasing long dated call options. So these are ways that I can allocate some money and have leverage to the upside, but limited risk to the downside. And in the grand scheme of this account, if all these options went out worthless, that would be okay, because as we can see here, there's much larger positions in this portfolio than the $5,000 in value of this Apple position. So if these options go worthless, then I'm only going to lose 5 grand in those, which is not really a lot of money in the context of the overall portfolio. So I'm comfortable with the risk. But as I showed you earlier, you can plot the price of these options. And so if I pull up the chart here, we can see that these 200 calls in March of 2023, in late January, they were trading for $17 a piece, so $1,700 a piece. I bought them for $500 a piece. And so basically what my upside is here, if we were to say that Apple goes back to $145 or $150 over the next few months, the sooner that happens, the more I'll make on those calls. But basically my estimated upside if Apple goes back to 145 is about 3x on these calls. And that's because they're currently trading for $500 a piece or $5 a piece. But a couple months ago, they were trading for $15 a piece. But obviously, if it takes a few months, then there will be some time decay that does kick in for these options, because even though they are long-term options that decay very slowly, over a multi-month period, they are going to lose some of their extrinsic value because of that passage of time. And so my upside might be a little less than 3x if Apple goes back to 145 over the next few months. But regardless, I'm comfortable with buying a little more here and adding to my long-term Apple position. But I should mention that this is a speculative play, and if you are going to enter some options in Apple, just understand that that's your decision. I'm not telling you to do so. These are just some of the positions that I have, and like I said, I'm comfortable losing all $5,000 here if that's what it comes to. What happens to options and strikes if stock is split? It's a good question. Let's go through some math here. If a stock splits, what happens to options in a stock split? If a stock splits, the number of shares outstanding increases, but the share price decreases. So for example, let's say XYZ stock is $1,000 per share, and they do a, let's say they do a 5-to-1 split. This is exactly what Tesla did. Basically, this means that there will be, well, hold on, shares outstanding. Let's just say 100 million. Well, let's just say, let's make it easier here. 1,000 times 1,000. Okay, so market cap equals $1 million. Market capitalization is the share price times the number of shares outstanding. So if you have $1,000 stock price and you have 1,000 shares outstanding, 1,000 shares times $1,000 per share gives you a market capitalization or public market valuation of your company of $1 million. So let's say that this company wanted to reduce their stock price to make it more accessible to smaller investors and just bring down the stock price overall, which could also improve the liquidity of it. What they could do is they could do a stock split. So let's say they do a stock split, a 5-to-1 split. That means they're going to basically reduce their stock price by a factor of 5. So this means that the share price will become $200 a share. So that's $1,000 divided by 5. But the number of shares outstanding will increase by, I don't know why it's doing that. Increase by a multiple of 5. So if the new stock price is $200 a share, the new number of shares outstanding goes up by a multiple of 5. So the stock price comes down by a multiple of 5. The number of shares outstanding increases by a multiple of 5. So we'll have 5,000 shares. So if we have 5,000 shares outstanding and then we multiply that by $200 per share, market cap, the new market cap is still $1 million. So look at this. So the stock price is $1,000 per share, and initially they had 1,000 shares outstanding. If we multiply those, we get $1 million market cap. Now they did a 5-for-1 split. So the new stock price is $200 per share, but the number of shares outstanding increases by a multiple of 5, and we still get that same $1 million market cap. So let's say initially we have, hold on, let me go to a new slide. If you do a 5-for-1 split, the options, the strike prices will divide by 5 and your contract quantity will increase by 5. So let me go ahead and just delete all this really quickly. Bear with me. So pre-split, let's say you own the $1,000 call option, one contract. So pre-split, you had the 1,000 call and you had one contract. Ignore. Post-split, you own the 200 call with 5x contracts. Yeah, the market is pumping into the close. So when you own options through a stock split, the strike price changes by whatever the split ratio is. So if the stock does a 5-for-1 split, that means the stock price will come down, will be divided by 5. And that means for options, the strike prices will be divided by 5, but the contract quantities will increase by 5. And so let's say that initially this pre-split you had one of the 1,000 calls, one contract, and let's say that was, wow, that's terrible. I can't write in this. Was a $10 option. And then after the split, basically you would have $2 option, 5 contracts. So you'd still have $10 of value, but you just have a different strike price and more contracts. So that's what happens when a stock split happens. That's what happens to the options. Strike price changes and your contract quantity changes. The market is absolutely ripping into the open or the close. I like it. I wonder if there was any news that came out. But anyways, the market is closing, so I'm going to wrap up this presentation. Thanks everybody for tuning in. I hope you learned a lot today. Covered a lot of material, a lot of stuff on early assignment earlier. And if you were wondering, or if you joined this live stream late, I will be uploading, or there will be a version of this live stream that will get uploaded after we finish this stream. So just stay tuned for the uploaded version of this live stream. And I will also add timestamps to the description so that you can skip through this live stream and you can find specific sections of the live stream, and you don't have to watch all 2 hours of it just guessing, where you could find some interesting content. So I will add timestamps so that you can clearly see where different sections of this live stream start and end. So yeah, stay tuned for that, for the upload. It might take a couple hours. And then if you do start watching the live stream when it's posted to the YouTube channel and there are not timestamps in the description, then refresh the live stream every few minutes, because I could be working on adding those timestamps while it is already uploaded to the channel. So if there aren't timestamps and you're watching it post upload and you want to get those timestamps to see where the different sections start and end, just refresh the live stream every few minutes, because I could be updating those timestamps while you're watching. All right. Everybody enjoy their weekends. Happy Friday. And I will see you all soon.